Debt doesn't have to control your future. The more you understand money, the smarter your financial decisions become.
The world now owes over $348 trillion. It sounds unbelievable, but understanding this number could change the way you think about money forever.
Imagine waking up tomorrow and finding out the world owes $348 trillion asterisk. Not million. Not billion. $348 trillion. It's a number so enormous that it's almost impossible to picture. If you spent $1 every second, it would take you more than 11 million years asterisk to spend that much money. But here's the scary part. This isn't science fiction. It's happening right now. And while most people worry about inflation, expensive groceries, or high mortgage rates, very few realize they're all connected to one massive problem that keeps growing in the background. A problem that could shape your paycheck, your savings, your investments, even your future. So where did all this debt come from? And what happens if the world can no longer keep paying for it? Let's find out. Hash the biggest number you've never thought about. According to recent global estimates, total worldwide debt has climbed to around $348 trillion asterisk. This includes government debt, household debt, business loans, mortgages, and financial obligations across nearly every major economy. In other words, almost everyone owes someone money. Governments borrow to build roads, fund healthcare, and respond to crises. Businesses borrow to expand, hire employees, and invest in new technology. Families borrow to buy homes, pay for college, or finance cars. Debt has become the fuel that keeps the global economy moving. Without it, economic growth would slow dramatically. But there's one important question. How much debt is too much? Debt isn't always the enemy. Most people hear the word debt and immediately think something terrible is happening. But that's not always true. Imagine you borrow money to start a successful business. That business grows, creates jobs, earns profits, and eventually pays back the loan. In that case, debt helps create value. The same applies when a family takes out a mortgage to buy a home they can comfortably afford. Or when a company borrows money to build a factory that produces products for decades. Good debt can build wealth. The real danger begins when borrowing grows faster than the ability to repay it. That's where today's crisis starts. Why debt exploded asterisk. For years, borrowing money was incredibly cheap. After the 2008 financial crisis, central banks around the world slashed interest rates to historic lows. Then came the COVID-19 pandemic. Governments spent trillions supporting businesses, hospitals, and families. Central banks injected massive amounts of money into financial markets to prevent economic collapse. The strategy worked. The global economy survived. But it came with a cost. Debt reached levels the world had never seen before. For a while, it didn't seem like a problem because interest rates stayed near zero. Borrowing was inexpensive. Monthly payments remained manageable. Many people assumed that would continue forever. It didn't. Everything changed when interest rates rose. When inflation surged, central banks had little choice. They raised interest rates aggressively to slow rising prices. And suddenly, the cost of borrowing changed almost overnight. A family buying the exact same home now faced much higher monthly mortgage payments. Businesses saw financing become more expensive. Governments had to pay significantly more just to refinance existing debt. The debt itself didn't disappear. It simply became much more expensive to maintain. That's why economists often say, the size of the debt matters. But the asterisk cost of servicing that debt matters even more. Why this matters to you. You might be thinking, I don't owe billions of dollars, so why should I care? Because global debt affects almost every part of your financial life. Higher government borrowing can influence taxes and public spending. Higher interest rates affect mortgages, credit cards, and business loans. Companies facing expensive debt may slow hiring or reduce investment. Investors react differently when borrowing costs rise. Even your retirement savings can be affected by changes in interest rates. In other words, whether you realize it or not. You're already living inside this system. And the next question is even more important. What happens if the world keeps borrowing faster than it can grow? The answer may surprise you. The $348 trillion crisis nobody is ready for. Part 2 approximately 4-5 minutes. So what happens if the world keeps borrowing? Does everything eventually collapse? Not necessarily. History shows that countries usually escape large debt burdens in one of 4 ways. They grow. They inflate. They cut spending. Or they default. Let's start with the best outcome. Growth. Imagine a country with $10 trillion in debt and a $20 trillion economy. If the economy grows to $30 trillion while the debt stays relatively stable, the debt becomes less overwhelming. This is why economic growth matters so much. More businesses. More jobs. More income. More tax revenue. Growth doesn't magically erase debt, but it makes the debt easier to carry. That's the ideal scenario. The problem: growth isn't always fast enough. Especially when populations age, productivity slows, and borrowing costs rise. So governments often turn to another solution. Inflation. Inflation. Nobody likes inflation. But inflation can quietly reduce the real value of debt. Imagine you borrowed $300,000 with a fixed-rate mortgage. 10 years later, your salary has doubled because wages and prices increased over time. Your mortgage payment might stay exactly the same while everything else becomes more expensive. In real terms, that debt becomes easier to repay. That's one reason inflation can sometimes help borrowers. But inflation has a price. Savers lose purchasing power. Every dollar buys less. Retirees living on fixed incomes can struggle. And if inflation gets out of control, trust in the financial system begins to break. Which brings us to the third option. Austerity. Austerity means cutting spending. Governments reduce budgets, cancel projects, raise taxes, and try to bring debt under control. On paper it sounds simple. Spend less. Borrow less. Fix the problem. But in reality, austerity can be painful. Public services may shrink. Economic growth can slow. People may lose jobs. And voters often resist large spending cuts. That's why many governments find austerity politically difficult. Then there's the final option. The one nobody wants. Default. Default happens when a country can't meet its debt obligations. In simple terms, it can't pay what it owes. When that happens, investors lose confidence. Borrowing becomes far more expensive. Financial markets can panic. Businesses struggle. Citizens suffer. History has shown that debt crises don't always start because debt is large. They often start because confidence disappears. As long as investors believe they'll be repaid, countries can continue borrowing. But when trust breaks, everything can change very quickly. So is $348 trillion a disaster? Not necessarily. Large debt alone doesn't guarantee collapse. What's more important is, can the debt be serviced? Can economies continue growing? Can inflation stay under control? And can governments maintain the trust of investors? Those are the questions that really matter. Because debt itself isn't the villain. Uncontrolled debt combined with rising interest costs can become the problem. What should you do? You can't control global debt. You can't control central banks. You can't control interest rates. But you can control your own financial decisions. Build an emergency fund. Avoid unnecessary high-interest debt. Invest consistently. Increase your skills. Think long-term. Because people who understand how money works are often better prepared when the world changes. And the world is always changing. Final thoughts. The $348 trillion crisis isn't just about governments. It isn't just about economists. And it isn't just about Wall Street. It's about the cost of money. It's about the system we all live in. Because whether you're buying a home, building savings, investing for retirement, or planning your future, interest rates, debt, and inflation affect you. The people who ignore that reality may struggle to adapt. but the people who understand it. They have a chance to make smarter decisions. Because the future doesn't belong to the richest. It belongs to the prepared. If you enjoyed this video, subscribe for more videos that explain money, investing, and the economy in simple terms. And remember, understanding the system might be one of the most valuable investments you'll ever make. Please subscribe now.